charity or giving back, and yet they've all done stuff very actively to help the disadvantaged. I'm not sure how or why it all happened, but I guess it starts again with the mother that was with them so much time and taught them values. But it's bizarre because I'll never forget in the 3rd grade, we had a teacher review with our oldest child. She wasn't there. And the teacher wanted to know what Fiona had done because the other wealthy kids were all bragging how they had country houses and this and that. And she said that Sarah, our oldest daughter, would never ever talk about any of that and wanted to know how we had schooled her in that. But it was never ever brought up. So we'd never hid their wealth from them. So Fiona kind of broke every rule in the book that you would read about in dealing with this subject, but things have worked out extremely well.
Well, congratulations. There's nothing like a happy man and a happy family. So moving on to the world that we're living in, this has been an especially volatile year. We've got a new Fed chair. We have possible contagion in emerging markets. We have a huge new fiscal stimulus in the US, which is distorting things. And we have a very aggressive foreign policy and trade policy on the part of the United States. So taking all that and whatever else you're focused on, what are you really thinking about? Where's your focus right now?
Yeah, well, since free money was instituted, I have really struggled. I haven't had any down years since I started the family office, but thank you for quoting the 30-year record. I don't even know how I did that when I look back and I look at today, but I probably made about 70% of my money during that time in currencies and bonds, and that's been pretty much squished and become a very challenging area, both of them as a profit center. So while I started in equities, and that was my bread and butter my first 3 or 4 years in the business, I evolved in other areas. And it's a little bit of back to the future the last 8 or 9 years where I've had to refocus on the equity market. And I also have bearitis because I made my highest absolute returns were all in bear markets. I think my average return in bear markets was well over 50%. So I've had a bearish bias and I've been way too cautious the last, say, 5 or 6 years, and this year is no exception. I came into the year with a very, very challenging puzzle, which is rates are too low worldwide. You have negative real rates, and yet you have balance sheets being expanded by central banks at the time of $1 trillion a year, which I knew by the end of this year was going to go to zero because the US was obviously going to go from printing money, QE, to letting $50 billion a month, starting actually this month, run off on the balance sheet. I figured Europe, which is doing 30 billion euros a month, would go to zero. So the question to me was, if you go from $1 trillion in central bank buying a year to zero, and you get that rate of change all happening within a 12-month period, does that not matter if global rates are still what I would call inappropriate for the circumstances? And those circumstances you have outlined perfectly. You pretty much have had robust global growth with massive fiscal stimulus in the United States, where the unemployment rate is below 4. If you came down from Mars, you would probably guess the Fed funds rate would be 4 or 5. And you have a president screaming because it's at 175. Maybe because I have a bearish bias, kind of had this scenario that the first half would be fine. But then by July, August, you'd start to discount the shrinking of the balance sheet. I just didn't see how that rate of change
Right.
would not be a challenge for equities. That other than PEs, and that's because margins are at an all-time record, we're at the top of the valuation run on any measure you look, except against interest rates. And at least for 2 or 3 months, I've been dead wrong. So that was sort of the overwhelming macro view.
Yeah.
Interestingly, some of the things that tend to happen early in a monetary tightening are responding to the QE shrinkage, and that's obviously, as you've cited, emerging markets.
Right.
So the cocktail I mixed up for here was to continue, and this has been going on for 3 or 4 years at my firm, to continue to own the disruptors. That would be the cloud-based companies, the internet companies, to be short the disrupted, which would be things like retail, staples, that kind of stuff. And with regard to China, to continue to own who I thought would be the winners in the Chinese internet. It's been a below average year, mainly because the Chinese internets, which were very, very good to me, the last 2 or 3 years have been pretty much of a disaster this year. I gave an interview at Sun Valley, not this year, but last year, and said that I thought the Chinese internets were at less risk of government regulation than the US internet. And everyone in the audience howled with laughter. And I said, no, I'm serious, because they're partnering with the government because they have all this information that they hand over to the government. The internet has been the greatest friend the Communist Party could ever imagine, whereas 15 years ago, I would have told you the internet was going to destroy them. Well, at least on the gaming side with Tencent, I've been dead wrong, and it's tended to drag that whole group down. The other thing that happened 2 or 3 months ago, mysteriously, my retail and staple shorts that have just been fantastic relative to my tech longs just have had this miraculous recovery. And I've also struggled mightily, and this is really concerning to me. It's about the most troubled I've been about my future as a money manager, maybe ever, is what you mentioned, the canceling of price signals. But it's not just the central banks. If it was just the central banks, I could deal with that. But one of my strengths over the years was having deep respect for the markets and using the markets to predict the economy, and particularly using internal groups within the market to make predictions. And I think I was always open-minded enough and had enough humility that if those signals challenged my opinion, I went back to the drawing board and made sure things weren't changing. These algos have taken all the rhythm out of the market and have become extremely confusing to me. And when you take away price action versus news from someone who's used price action news as their major disciplinary tool for 35 years, it's tough, and it's become very tough. I don't know where this is all going. If it continues, I'm not going to return to 30% a year anytime soon. Not that I think I might not anyway, but one can always dream when the free money ends, we'll go back to a normal macro trading environment.
Well, let's talk about the algos. We haven't seen the algos sell. We've seen the algos buy. We saw a little bit of it in February when there was some concentrated selling. We saw it in China in 2015, which was really scary. Most of the people weren't focused on that, but I was. I think you were too. And they're programmed to sell if the market's down 2%. Machines are running, can't be stopped. Huge amount of trading and money is being managed that way. And we've been operating in a bull market and a strong economy. What happens when it's a bear market and a bad economy? And will things get out of hand? So knowing that, and knowing that we're at risk of that any moment unfolding, January, February just came like this. How are you protecting yourself and insulating you? What are you watching for that might happen?
It's a little bit like after 9/11, waiting for the next terrorist act, in which case you would have missed a roaring bull market for the next 6 years because you're sitting there because Dick Cheney told your neighbor you're supposed to move out of New York. I'm just going to trust my instincts and technical analysis to pick up this stuff, but I will say that, and I've proved it to my own detriment the last 3 or 4 years, the minute the risk reward gets a little dodgy, I get more cautious than I probably would have been without this in the background. But I want to be clear that the major challenge for the algos, for me, is not some horrible market event.
Right.
I can actually see myself getting caught in that, but I could also see myself perhaps taking advantage of it.
Right.
The challenge for me is these groups that used to send me signals,
Right.
it doesn't mean anything anymore. I gave you one example this year. So the pharmaceuticals, which you would think are the most predictable earning streams out there, so there shouldn't be a lot of movement one way or the other. From January to May, they were massive underperformers. In the old days, I'll look at that relative strength and I'll go, this group is a disaster. Okay, Trump's making some noises about drug pricing in the background, but they clearly had chart patterns and relative patterns that suggest this group's a real problem. They were the worst group of any I follow from January to May. And with no change in news, and with no change in Trump's narrative, and if anything, an acceleration in the US economy, which should put them more toward the back of the bus than the front of the bus because they don't need a strong economy, they have now been about the best group from May until now. And I could give you 15 other examples, and that's the kind of stuff that didn't used to happen. And that's the major challenge of the algos for me, not what you're talking about. Now that might be a challenge for society and the investing public in general. And yes, I could get caught like anybody else in them. But yeah, there's probably some degree of having one foot out the door that I otherwise might not have, because I do know this is in the background. You do know, though, I skimmed the article, but there was something in the paper about how we're taking more measures to put in circuit breakers, whatever they call those things, to stop the phenomena you're talking about. Doesn't mean they'll be effective, but.
So how are the algos operating? Why are they distorting the price signals?
Well, I'll just again tell you why it's so challenging for me. A lot of my style is you build a thesis, hopefully that no one else has built. You sort of put some positions on, and then when the thesis starts to evolve and people get on and you see the momentum start to change in your favor, then you really go for it. You pile into the trade. It's what my former partner George Soros was so good at, and we call it, if you follow baseball, it's a slugging percentage as opposed to batting average. Well, a lot of these algos apparently are based on standard deviation models. So just when you would think you're supposed to pile in and lift off, their models must tell them, because you're 3 standard deviations where you're supposed to be, they come in with these massive programs that go against the beginning of the trend. And if you really believe in yourself, it's an opportunity. But if you're a guy that uses price signals and price action versus news, it makes you question your scenario. So they all have many, many different schemes they use and different factors that go in. And if there's one thing I've learned, currencies probably being the most obvious, every 15 or 20 years there's regime change. So currencies traded on current account until Reagan came in, and then they traded on interest differentials. And about 5 years, 10 years ago, they started trading on risk on, risk off. And a lot of these algos are built on historical models. And I think a lot of their factors are inappropriate because they're missing. They're in an old regime as opposed to a new regime, and the world keeps changing.
Right.
But they are very disruptive if price action versus news is a big part of your process, like it is for me.
So how does that play out? Is it just going to get worse, or does it blow up? How do you see it?
I pray it blows up, but I don't see that happening because money managers are so bad. I assume they're going to outperform 90 to 95% of the money managers.
Yeah.
I think I don't know whether you've read Kasparov's book, but
Yes.
he thinks like the ultimate chess player is not the machine. It's the machine with the man and his intuition using the machine heavily. I think there's always going to be 5 or 10, maybe not a lot more humans who the best machine in the world, the AlphaGo type thing, will never beat that human as long as he's using the machine.
Right.
And they need to be used and they need to be understood. I can't see me passing my money on to a machine, but I think I'd be an idiot not to know the effect these machines are having, and frankly, using them as just one more input that I didn't have 20 or 30 years ago. But you've got to understand when the signals are real and when they're driven by them, and you got to understand the time frames.
Are you using machines yourself?
I have money with a couple of machines. It's a very small amount of money. It's just enough money so they send me signals when they think something dramatic is happening. And I'm early enough on in the process that I don't know my conclusion. But I assume a lot of these machines are on the same factors.